Hey everybody, I'm here with George Coyle. I've been trying to get George on for a long time. He's been, one of the dudes I always go to and I read his stuff and I'm like, man, he has a lot to say to the trading world. And he really hasn't come out much and talked to any of us in this format yet. So it's really great to have him on here. George started an investment firm called Triangulated Capital Management, which combines traditional indexing with trading principles. He calls it tradexing. The end goal is a more tolerable ride versus buy and hold, which is very important. Buying and hoping that the market's going to do what you want it to do isn't a great strategy. So that's a really cool thing. We'll talk about that more. And he has a couple Substack channels. And so we're going to get to that today. And I will also link those in the description. One is interpretation of price action and market meditations. So how are you doing, George?
Doing all right, Jason. Thanks for having me on. It's my first interview.
That's exciting, man. I know there's a lot of people who read your stuff, and it's really great to just kind of hear somebody who's really diced down all this stuff. Like if I want to know who's real, who's fake, who's saying crazy stuff, what's the correlation between the good traders? You talk to George, you read his stuff. He's got a bunch of great PDFs out there. I've read them. I read them all the time. Every time you put one out, I'm always reading it, checking it out, because it's important to understand like what's really the big secrets in trading. Everybody's like, I need the secrets in trading, and they read Market Wizards and they read this, and the guys say stuff, and they're like, yeah, just hold your positions and hold the winners and cut the losers, and everybody knows that normal stuff, but you really dig deeper. And I like the way you put it, where you also said there is the what's it called? There's the top tier principles, and below that, the second tier principles, and you also don't know which one is the most important. You like to say that both of those are incredibly important. So can you explain those principles?
Sure, most important is interesting. It brought to mind an Ed Sakota quote where it's like, which organ in the body is the most important for sustaining life? Is it the heart or the liver? And it's like they all work together as a system, essentially.
Yes.
But what I was doing, and I wrote a book called Principles of Great Traders that's free. You can get it at traderprinciples.com.
Yes, that's the one I'm talking about. Yeah.
Right. And what I did, just kind of a little backstory on it, is I was designing different trading systems and seeing what worked and what didn't. And I had been doing it for a lot of years, and I started to see certain consistencies in the trading systems that could handle a lot of money and withstood the test of time. And then I started to notice that, I've always read a lot of stuff. I've read books, Martin Zweig, George Soros. I don't know why. I'm just kind of fascinated by the business. But I started to see similarities, and it would be things like Soros saying, like, the secret to my success is that I know when to get out, things like that, right?
Yeah.
And I said, man, I need to bring together all these parallels and find out what's consistent. So I actually took a matrix. I'll use the screen, and I said, here are the traders and here are the variables. And it might be ride your winners, diversification, et cetera, et cetera. And I just did little check boxes, and I found that there were only three things that everyone was consistent on. And those were respect price action, follow the price trend. Obviously, there's a lot of different price trends. Stick with your winning positions, which is hold your winners, ride your winners, and then cut your losing positions. And outside of that, nothing else was consistent. So the primary three again are, follow, respect the price action of the market, listen to the market, since publication I have, ride your winners and cut your losses. Then the two secondary that everybody was pretty consistent on were don't overtrade, which means don't use too much leverage. And it's kind of obvious. It's like if you bet everything every hand, you're going to lose eventually because you can't win every time. So you'll wipe out, right? And the other one was to manage your emotions, because if you get too emotional, you start to do stupid things in markets. But outside of that, nothing else was consistent. You take diversification, for example. You have Ray Dalio calling it the Holy Grail. You have Stan Druckenmiller saying it's the stupidest thing going these days. And you have very disparate camps on that historically as well. So anyway, I found these five things and really the top three, and I started to incorporate those into everything I did, and my results got a lot better personally.
Yeah.
So that's kind of the high overview of all the research.
No, I love that because it's incredibly important to just understand those basic parts of trading because it's when you do anything, whatever it is in life, you find it to be overwhelming, hard to understand. There's so many different strategies, so many different ideas. You go on Twitter, you're going to be even more confused. There's 50 people on here saying they win every single trade. There's more people talking about how great they're doing every single day, and they might not be. You have all of those things kind of coming together, but if you really just dice it down like you did and kind of understand, how do I simplify this? Because there are things that these people have in common. I mean, even things like diversification, like, yeah, like there are differences there, but it doesn't mean they trade just one thing. Even when we're talking about Druckenmiller, he's not just trading one thing at a time either. So there is diversification. There's a specialized, like a kind of there's a shotgun approach. The trend followers like myself kind of have more of a shotgun approach.
Hmm.
And then there's people who kind of have a rifle approach where they're really trying to hit these few areas and do them well. But also, when you look at their history, like someone like Druckenmiller has traded all over the place in the years. So, there's a bunch of different ways to look at it. But like you said, you kind of diced it down, figured out, cutting losers, listen to price action, ride winners, like manage your emotions, don't overtrade. I think those are the things you really kind of harp on in your books. And so kind of getting to that, what are the things like, that you think, like the secondary principles you're talking about, manage your emotions? What are some examples that you've seen of that made you say like, hey, this is one of the most important things out there?
In terms of managing emotions.
Yes, and other traders.
Um, well, I guess, if you trade for yourself and you do it with leverage, it's sort of like amplified learning, which is torture, but also a faster education. And when I was a young, more foolish person, I would trade really aggressively sometimes. And I remember once I bought whatever for whatever reason, I can't remember at this point. And then it went down. And so I got out and reversed the position and traded that side. And then it went back up. So I got out and reversed it again. And I lost on all three of those trades within a day. And I remember I read it, I think it was Richard Dennis, maybe Jim Rogers said something similar, but definitely Richard Dennis. And it was, don't do that. Don't reverse positions. Don't fight with the market. Don't try to make it back. And when you think about it, it's pure emotion, right? Like you're only reversing because you're like, I was wrong. I'm going to get my money back. And whenever you get into that, like, I'm going to get my money back, it's like something needs to go off in your head that says, no, 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 you're violating like a truism of trading. Stop it. So I guess what I would say with the emotions is it's just interesting because you'll make these mistakes if you actually trade long enough, and then you start to see, hey, I'm not the only guy who made these mistakes. So did so and so 20 years ago and 100 years ago, and all the principles really. Like I'd mentioned this before we hit record, but I'm reading Arthur Cutton's biography. It turns out there's only
Yes.
like 4 copies in America per WorldCat, and I got
Oh,
a
really?
PDF. Yeah, I think there's a PDF on Covell's site. But anyway, he was Jesse Livermore's nemesis, and he talks about how he started out scalping in the pits, and then he ultimately wound up realizing that he had to hold his positions, and the secret was to cut your losses. And it's like, yeah, this book is. I mean, his trading was kind of in the early 1900s, so it's 100
Mm.
years old. And same things again and again and again. And you get too emotional and you do stupid things, and then you go on tilt, like they say in poker land, and you lose money.
Yep.
So, yeah, I guess like the principles are. It's kind of interesting because I think people see them in different ways. I was reading those books 20 years ago. They didn't mean as much as they do to me now. And like you tell people that stuff and they're like, yeah, that's just like a platitude. I mean, whatever you're telling me. But it's really when you see it in that light, they become sort of so important and so valuable. And I think it's like sometimes I think of like a stock car, where
Mhm.
you've got the frame and the frame has to be solid, and then you can kind of design a slightly different body and you can put different decals on it. And maybe trading is similar in the sense of you have to have these inherent principles. And I think one of the things that's interesting too is following trends could be following the trend in the equity curve of your mean reversion strategy, right? So it doesn't mean that
Mhm.
you have to necessarily follow price trends. You could say, hey, I've got a mean reversion strategy that the equity curve looks like this, and I follow that trend and I get out if it stops working, et cetera, et cetera.
Yeah.
So,
Yeah, no, that's great. And in general, like you said, managing emotions is everything. And I think that, like you said, if you're sitting there And I love that what you said earlier about, the guys, and the thing that kind of happens over and over again as you're scalping, you're going like, some days you have good days, some days you have bad days as a scalper, and most
Mhm.
days are bad days, to be honest. And I remember as a scalper, for me, one of the early conversations I had with a trader who I knew was actually a good trader. I was like, oh, he's actually a talented trader. He's very good at this. So I sent him my trades, and I was like, I did these really great trades. And he's like, well, how exactly did you do it? And I had no really good answer. Like I bought when I decided I did, like I don't know, like today I laugh about it because I probably came up with some stupid thing to say to him, but there was nothing.
No
And he,
process.
yes, and
Yeah.
there was no process, no methodology, no nothing. And I remember forever, I'll always remember what he said to me. He said, well, if you don't know how you did it, you can't do it again, and it doesn't fucking matter. And like and when he said that, I was like blown away, like, whoa, that was such a big point for me to change things. And like that's one part of the journey. And then the next part of the journey is really understanding like you need your winners to really be outsized to get rid of all your losers. Like you're going to have losers. There's nobody like, yes, there's people who talk about their, 50% win rates. And yes, if you just keep buying on the way down in the S&P, probably one day you'll make your money back and you can talk about your winning trades. However, there's nobody who really has enough capital to really do that, and you'll lose a bunch of money over time. It just doesn't make sense. But the low win rate systems, and understanding that you can take your losers and take them small and have these outsized winners that pay for all your losers, that's everything. And that's the real secret of trading. It isn't just, continuing to have this high win rate system. It's understanding that as long as your losers are small and your winners are big, you're a winner.
Brought to mind something I wrote within the last few months on the market meditation Substack, and it was I'm going to just read a little bit here, but it was Western culture is the enemy of trading. And really,
Mm.
I pointed out that like the kid who runs away from a fight in grade school, he's not, nobody's putting him on their shoulders and having a ticker tape parade for him. But in trading, it's like cut your losses, run away.
Mm-hmm.
We're culturally attuned to like frequency as opposed to magnitude winning. So like if a football team loses 9 out of 10 games and then the 10th game they win by 100 points, it's like, yeah, whatever, they were losers, they lost 9 out of 10 games. But with money, it's like if you lose by a small amount 9 times a dollar, then you make $100 the 10th time, you're up $91, so that's
Yeah.
money good. Yeah, and there's other things like with trading, you want to be a front runner, right? Like you
Mm-hmm.
want to go with what's working. You can't have any real loyalties to positions, which incidentally, it's interesting. A lot of like great traders are divorced a couple times, but that's probably a different story for another day. But essentially, like, you probably remember the kids who is you'd show up with like the Cowboys hat, even though you're not from Dallas, right?
Yep.
When they win the Super Bowl and they're like, what happened? I'm from Cleveland area originally. And it's like, if you got a hat other than the Browns, it's like you're a trader, but it's like, that's what you want to do as a trader, not a traitor.
Mm-hmm.
You want to go with what's working. And so all these things that, we're culturally attuned to really sort of make it's hard to be a good trader because the key attributes I think of traders are sort of against the grain of what we've been brought up to view as socially acceptable. So anyway, I think that's all very interesting because it's like you kind of have to unlearn social expectations in order to get to a point where you can be pretty successful with trading, or at least that's been the case with me.
Oh no, I totally agree. That's such an interesting viewpoint because that's, especially I grew up in Cleveland too. So growing up and
Sorry, man.
yeah, I know, like if you're a Browns fan, you're a Cavs fan, like yeah, like we finally won something finally, but like once again, like we didn't win anything forever and ever and ever. There was a drought in that city for, 100 years or something, you
Yeah.
know. So with people, always would come in with different, oh, I like the Steelers. Everybody loved the Steelers in Cleveland because you could actually watch them win, like you could watch an actual winning game. If you're in Cleveland, like you're not a Browns fan, but like you said, that's what you want to do in trading. And also most of the things in life are inherently very different to trading. Like if you're looking for your momentum trader, you're waiting for the price action in general to just kind of, even if you're a fundamental person, you want the price action to also clarify for you that it's working and the market's confirming what you're seeing.
Yeah.
So if you do that, that's also against what we normally do when we're looking for the cheapest, the best price, the best quality at the best price over and over again. That's what we're doing all the time in the real world. But in trading, it's the opposite. So you just have all these like intricacies there that are quite interesting.
Yeah, that was another thing I had. I didn't read the whole post because put people to sleep, but it talked about how we all want a deal, right? And like most retailers figured out that if they constantly have sales, like, hey, my $100 shirt was only 50, I got value. So I think we're inherently in a place where we want to get value in what we buy. And, with stocks, it's like you buy things that are moving up. And a lot of times I'll think about local businesses and like, okay, there's a pizza shop down the street that's struggling and I could buy it, but then I have to fix this, this, and this. And like, how's that compare to buying one that's just humming along and I could open another one? And so I think you can come to sort of justify buying high and selling low in your mind over time if you think about it enough. But definitely the and just to be clear, you buy high and then sell higher, or you short
Yeah,
low and cover lower.
good
But
point.
that's kind of against the idea of like, we're going to buy down here and sell up here. That most of the world runs on. And I guess the media feeds a lot of stories and narratives. And you even see that with famous macro traders. They tell a lot of doomsday narratives when they go out and speak, but then they'll also point out that the way they trade is not really in line with those fundamentals unless the price agrees with it, to your point a minute or two ago. And that goes back to
Yep.
Livermore. It's like only add to your position or take a significant position if the price confirms your opinion. I'd say like price is probably the thing that is the most undervalued in mainstream finance these days. And and it's in the book I have, but there's all kinds of justifications as to why it matters. It's like the only accurate information. I think it was Larry Height in his book, The Rule, who said, yeah, I don't need 1,000 data points to know that Microsoft's cloud business is booming. The stock price is telling me, and it's telling you too. And there's just, if you read it and you read what I researched, I think you'll be like, wow, like it's basically a book of quotes essentially from different people saying the same things over 100 years. And you'll start to see it in that different light and say, wow, okay, I get it. Like I understand why price is important. Because I think, at least for me, initially, it was very difficult to accept. Why would I pay attention to that? That's silly. It has to be more complicated than this. But most of the times that I've ever been involved with or gotten behind the curtain at the Wizard of Oz type of stuff, like what's going on back there is not rocket science. It's pretty simplistic stuff, and it's the principles. So
It's human nature, you really, humans, we really want to make everything super complex all the time. It's got to be more complex. It's got to be harder than that. It can't be that easy. But I can also say why, another thing I always say, why price action is incredibly important and people don't put this together, which is if I take just a basic data point on stocks and fundamental wise, I can't just pick one and be like, I buy for this reason. Like you really can't. Price action, I could just say, yeah, I buy 100-day highs and I sell 50-day lows, and you can actually make money that way. That sounds crazy, but like, yes, it actually is true. Like, yes, your risk management has to be there. All those things have to be there to make that happen. But price action is everything. And you can tell everything for price action and relative strength, like all those things tell you everything. But looking at, the market and what they're, or the stock and what it's telling you and what the CEO's telling you, like they have a job to do. Their job is to tell you to buy that stock and give you reasons why. The
yeah,
price doesn't have any job to do but tell you the truth. Here you go. This is the truth of the market. We're doing badly or we're doing well, and like, yeah, there's somebody will say, oh, well, there's a stock that's been in a downtrend for 5 years and their business is booming. Yes, but do you want to own that? Like, do you want to own that stock? No, the answer is still no, because the only thing, we don't get paid because I know that this fundamental thing is going to happen, or this piece of news is coming out. We get paid based on the price. And if the price is going up, we get paid. And if the price is going down, we lose money if we're long. So that's the most important thing. And I agree with you. The price action is everything. It's the most important thing above all else. And you have to have that. I don't know any, and people always talk to me and they'll be like, I remember I was doing a spaces the other day and I was talking about all these fundamental traders. And I was like, if you really dice it down, you'll see that most of them use moving averages. And you've been in the business a long time. everybody I've ever seen in the business, when they tell me they're fundamental, they have some sort of moving average, breakout indicator on their charts every day, you know? So it's like, and they're waiting for price levels, or they're buying at this support or resistance breakout, whatever it is, there's always something like that. So once again, it's like everybody uses it, whether you pretend you don't. And how do you, and also you can't really risk manage properly without understanding the price action too.
Yeah, I mean, I guess what I'd say is the guys, I think it's pretty much a proven fact at this point that the people who produce the best results in markets are discretionary, right?
Mm-hmm.
But what you also find is that the guys who are the best historically, and there is some element of like being an early mover in the space and a lack of competition that accounts for returns. But they look at fundamentals and they look at price action and they use the two together, but I don't think they
Mm-hmm.
tell people that they're using the price action stuff as much as, things like this, where we're like, this is what really matters.
Mm-hmm.
Because my sense, and nobody's ever, admitted this to me, but it's like they know that to get people's attention, you have to tell a compelling narrative.
Mm-hmm.
And trend followers have the no narrative, which is like, I don't need to know a narrative,
Yes.
which just doesn't sell as well as like, hey, legacy spending and entitlement programs are going to end life as we know it, and debt to
Mm-hmm.
GDP, and lions and tigers and bears, and run for the hills. So
Well,
I
they're all
think
long.
yeah, right. It's like, and I not to single him out, but like Druckenmiller's been doing a lot of speeches recently, and he did one at
Mm-hmm.
USC about a year ago. And it was interesting because he spends a lot of that speech talking about like all the case for being short. And I won't rehash it, people can go watch it. But then at one point, it's like a 30-second thing, and he's like, I'm not short. I probably should be with the way I'm talking. But the market's going up, and it's like, oh man, that's what matters, right? It's like,
Mm-hmm.
so I don't know. I think that the people who are the best, they combine the two, and I think that the guys who have the best returns historically, they tend to do the fundamental analysis and combine it with the price action. And then when they think something's great and the price confirms it, that's when they really take big positions.
Mm-hmm.
But they won't fight price action. I guess their highest priority is sort of, I need to survive. And I think that all comes from basically the Commodities Corp camp, which is,
Mm-hmm.
Michael Marcus, Ed Secoda, Bruce Kovner, Louis Bacon, and Paul Tudor Jones. They all came out of there, and they all knew Soros and Druckenmiller. So all those guys have similar strategies if you sort of research the history of that, I guess, the Princeton, New Jersey camp.
No, that's great, and that's and I also, as you did say, I have had a person come up to me and straight tell me that they actually are breakout system traders, and like they
Okay.
basically are systematic, and they also write all the time about these things. But even when you do that, you're still kind of going, okay, here's the price action, and then like you said, like you're writing your fundamental thesis, because that's what I do is more, I'm just being completely honest. I'm kind of a person who will go, okay, well, I'm seeing relative strength flow into these areas. What would the narrative be to make this happen for the price action to be moving this direction? And then I kind of come up with my fundamentals, and like I let them be more price action based, because really it's like, yeah, I probably could just trade just straight off the charts and not even think about it. But I do like to have that feeling of like, why am I holding this position? This is why I'm holding the position. This might be why I get a little bit more bullish on something, like just the background of it. Simply put, like if you do look at 2020 and you go, okay, like obviously commodities were going to move. If I'm looking at 2020 and going, okay, commodities are going to move, I have all these price action signals, I can easily come up with a thesis. And also looking at the Fed, like you're looked at rates at zero, QE infinity, helicopter money to anybody who wants it. Like you can kind of put it together in your head what's going to happen. And then you're starting to see the price action confirm it. That's when you get the signals, and it's kind of like, yeah, Druckenmiller could, or somebody could kind of go like, hey, this is in this uptrend and I'm not going to fight it, but there is this very bearish thesis coming. And you're ready for it. That's the other thing. You can be ready for things and be on the other side of it. This whole year, this was the thinnest rally I've ever seen, at least. And I was long it for most of the year, like, and then finally it comes down and goes the other direction. And it's like, yeah, like I could tell you that that was going to happen, but I'm not making money by sitting there while it's going up and say, hey, it's going to turn around at some point. That doesn't make anybody any money.
Yeah, it's interesting on the macro narrative. I think that, like, I spent some years as a macro strategist of sorts, and
Mhm.
you can always find a compelling bull case and a bear case for pretty much
Yes.
any commodity, currency, or bond market, in stock market in aggregate for that matter. And so it does kind of lead you to, like, okay, there's compelling bull case, compelling bear case. How do you decide? And in the original Market Wizards, Kovner talked a bit about having a compelling case for long the Canadian dollar
I
and
was
then
just gonna
short.
bring that up. I was like, yeah, because I just brought that up the other day in a writing. Yeah, that's the best one. Go ahead.
Right. And then he's like, but it broke down, I think. So I knew that the bearish case was right. It's sort of like, at some point you say, like, well, what's the point of having the philosophy if you've got a good and a bad, and then the price actually tells you which one is accurate?
Mhm.
And I don't know the answer. It'd be great to talk to him someday and ask him that question, because there are certain things he says that it would just be
So
interesting
you
to
could talk
examine.
about it with your friends.
Well, not so much that, but just to learn, like, and say,
No, I'm saying for Kovner, like it to talk like that's kind of what I think sometimes is like I'm like, why exactly do I do that? Because I do the same thing. And I'm like, maybe sometimes it's to fight boredom, maybe sometimes it's to chat about it with friends, like I'm not sure because but at the same time it does help you to just be like I think that's the important point isn't that part of it. It's just being open to both sides of the trade. Like that's I think a very hard thing for people to do.
I think so too, but I mean, if you look at history, it's like the optimists tend to win, right?
Hmm.
The pessimists have their day, and if people make a lot of money in a bear market, um, people become legends, right? Paul
Hmm.
Tudor Jones in '87 and Paulson in '08. But for the most part, the money's made on the long side, and I personally try to trade mostly only from the long side, because trading the short side is so difficult. I mean, bear markets trade way different than bull markets. Bear markets tend to just be jagged ups and downs, and you just, with the way I trade, I'm looking for sort of low volatility setups,
Hmm.
and I don't want things to reverse quickly. And bear markets, that's how they work, right? They jump all
Hmm.
over the place. So yeah, it's but I guess a lot of this gets to the point of, like, it is unique to each individual. You have to find out, what kind of markets do you like to trade, what type of environment, what's your temperament, what are your goals, and how does that all align with the principles to design an approach, a system, a strategy that basically works for you and your investors if you have them.
No, that's great. And yeah, it's I mean, I guess it's open to both because for even myself, like I really try not to get too much into stocks on the short side. And you know that just from back testing, like back testing stocks on the short side, it's very tough, especially if you're a futures trader and you're mainly trading the indexes. Like it's really, really tough. But if you're looking at commodities, you're looking at, the USD CAD example, like you do have to understand both sides of the trade. That is one thing that is kind of different, but in stocks, yes, the long side is usually going to be right. I think, I took a class from your Larry Williams years ago, and Larry Williams was one of the ones who said, if you're always bearish, like, and look over this and he puts up like a long-term chart and look over this period of time, like the market mainly goes up over time. So you're going to lose a lot of money if you always have this bear case. And he said if you're in this crashing type scenario and you are bullish most of the time and you can find a good like entry point, you're going to be right at some point more than you're wrong. He's
Mhm.
like, but you have to really wait for that entry point to come in. For example, like, we're not as trend followers. I'm never going to just wait as something's crashing and just start buying it. I'm going to wait for the momentum to come in. But being able to know that most of the time the market is going to turn back up, being on the short side, like the COVID crash is a great one for trend followers because they got in it and it went boom and they're making all this money and then it went right back the other way and wiped out the entire return because it was such a tough V bottom. So if you had like a 50-day high to basically get neutral, you were just you lost all your money basically by that point.
Yeah, it's, I'm a huge fan of trend following. I think that like the sort of longest demonstrated application of the principles is in trend following, because the systems are governed by those rules for the most part. But there's other things that happen in the world that I think it's hard to ignore, right? So
Mm,
for example, I'm an investment advisor, and when I log into the platform, I have choices of like long stocks, long bonds, and that's it.
mm,
It's not
mm,
like short the Australian dollar is a choice. And you
mm,
look at modern portfolio theory, and you look at basically most asset allocation for wealth management institutions, et cetera, and it's long bias. So there's
mm.
this gigantic force of money that goes into long stocks and bonds, at least in the United States. And those are things that in what I do, try to account for, because whether you like it or not, I mean, it's a reality, right? Somebody makes a
Mhm.
bunch of money, they're not going to be like, oh, geez, what should I do? I'm going to short the Kiwi. They're
Yeah,
going to be
yeah.
like, okay, I'll buy stocks or I'll buy bonds or some combination thereof.
Yes.
And I think that type of stuff could be very powerful in terms of designing investment strategies. And I know people will hear, well, there's going to be bear markets and you're going to get hammered. And I guess that comes down to, like, for me personally,
Mm.
I like to try to just get out of the way in bear markets, do as little as possible, if not nothing, and
Yeah.
wait. And there's this wide quote that always comes to mind where he's talking about the reality of markets is hoping that you'll survive panics, crashes, and plagues till so you live to see the light of another bear market, which
Mm.
we've experienced crashes and plagues in the last several years. So
Yeah.
it's maybe more poignant now. But anyway, yeah, I guess all this stuff gets to like, I think the principles have to be inherent to what you do to achieve success, because they do sort of withstand the test of time. But how you design your approach around that, there's just so much variability. And you see this in the Schwager books and everything else. It's like, there is no one right way to do things. There's a lot of different ways, which I find so fascinating. It's just there's so many different ways to peel the onion. So yeah. Anyway.
No, that's correct. And when you're looking at that, and you're basically what you're seeing, when you go into the portfolio, and that's the thing I talk about a lot is anymore. If you're even a person who's looking at their retirement accounts, there is no shorting this or doing that. I'm a futures trader. Yes, I get all of those things, but that's not everybody, and that's not where most of the money comes from. Most of the
Mhm.
money in the market is on the long side. It's crazy that alongside of bonds right now and stocks is kind of the thing that's been getting hit. The 60-40 portfolio has been a little bit tough lately, but still that's still the makeup of by be long stocks, be long bonds. And so basically when we're looking at those things, like there's also the other thing that you brought up, which is awesome, which is getting out of the way. Like there's nothing wrong with being like, hey, I'm just gonna take a break. This isn't the market. Like another principle in your book that you bring up is, and I think a lot of you have a bunch of quotes from the traders about this, which is nobody's strategy or system works all the time. And
Yeah.
that's a thing that I think is incredibly important. And even for me, like I know as a primarily a trend trader, my strategy does not work all the time. There's going to be periods of chop and where I'm just going to get chopped to death, especially when there's low liquidity. The only thing for me, what I do is I take down my positions quite a bit. I might have less positions, so taking down the size is incredibly important to me, or getting out. There's nothing wrong with just getting out and being flat. So you just have to figure out like what your strategy is, how to do it, and what you're good at, and what environments really benefit your strategy. Yeah, the trend followers, they had like most of those guys had a really tough time for some years, but yeah, 2020, yeah, it was easy. There's a lot of liquidity in the market. Be long just about anything at the end of 2020, and you did good through 2021. And then we get into this period, and it's a lot less liquidity now. You can't just basically buy just about anything across the market, and it makes money. And the trends are quite less, a lot smaller.
Yeah. I jotted a couple things down, but it's like, do you stick to one approach and capitalize on that one approach, or do you diversify?
Mm-hmm.
And I also thought, I can't remember where I saw it. There's so much stuff on Twitter now, it's probably there. But it was Bill O'Neill, his a lot of like traders can be traced back, kind of like academic papers at Site One, and Bill O'Neill's a huge one for stock traders that came after. But I saw his track record somewhere once, and I read that like there was a bear market where they were only 10% invested, 90% in cash, and his equity curve flatlined for 18 months or something like
Mhm.
that, more or less. And once you've traded long enough and you've seen enough equity curves, you're like, he was doing nothing or next to nothing.
Mhm.
And I think that's a big secret to success in these massive track records, is the willingness to just walk away. Now that's more
Mhm.
discretionary than running a system. And then with
Mhm.
systems, you have the choice, like, do you just say, hey, I'm going to be a diversified trend follower and keep plugging and know that
Mhm.
eventually it'll come back? Or do you layer, I think they call it stacking now, the stack
Mhm.
systems together so that they play nice together, but then you
Mhm.
don't get the bigger ups and downs? And yeah, I guess all these different choices, like how do you deal with this stuff? These are all things that there's no one right answer to. Maybe that's, I guess I keep coming back to that. And what I'm saying here is there really isn't one right answer.
Mhm.
It's very subjective. And to use another Sakota quote, he talks about, what's the best car, what's the best spouse? And it's like, it's unique to everybody, right? If you're the guy in Miami who's single, you don't want a minivan. And if you got a family of four in the mountains, you don't want a convertible. So it's I think there's so much discretion that can go into it, into what you decide to do. And the same goes for systems. I mean, you trade
Mhm.
systems, and
Mhm.
ultimately I think that there's the reality of systems is this, like, they're mechanical implementations of discretionary logic,
Yes.
because you have to use certain, whatever qualifiers or metrics you use. Is it
Mhm.
your mar ratio, is it your sharp, to decide on a system? And
Mhm.
ultimately, all of those decisions are discretionary, whether they're
Yes.
relative or absolute. And I think a lot of people don't understand that, maybe. So I've actually thought about writing a series on how to build a system, but I'm a little afraid to do it because it's kind of like, I remember when I first got statistics in markets, I thought, oh, geez, I'm infallible. I have statistics now, and it's sort
Nobody can
of
stop me.
yeah, right, right. I thought it was that easy. It's like, oh, a T statistic. Here we go. It's gonna be rich as can be. But yeah, I've thought about kind of explaining it along the way and writing some kind of book that really explains system design from the floor up. It probably wouldn't be a sexy page turner though. As you know, if you design systems, it's not exciting stuff.
Nobody cares, like it's funny how nobody cares, but once again, it's one of the most important things to understand. Like, even if I always tell people, like, you don't have to be a button pusher. You basically don't have to be like, I buy and sell. If you just have systems that basically tell you, like let's say you're a short-term swing trader, and you can see three different trends in the S&P 500, and you see that the long-term trend and the medium-term trend, or the intermediate trend, is up, and then the short-term trend is down. And, like, let's say you're mainly, as a swing trader, you do a mean reversion style strategy. You can just kind of understand those things, like, yeah, I can buy pullbacks in this type of environment, and just basic things by just creating your system. So I think they're the most important things. But yeah, I always put people to sleep because I talk about them so much. But it's really, just talking about it yesterday, we were talking about the high win rate systems, and how anybody can create these 90% win rate systems and tell everybody how great they are, and be like, oh, you're the dumb one if you didn't make money on my 90% win rate system. Like, yeah, you can do that, but most of the time those are flawed. They're heavily flawed. So you're able to kind of come in there, put together this idea of a system, how to create them, talk about, and it's discretionary. Like, how are you what position sizing, all those things are completely up to you. Or you can front run your systems. I see people do it all the time. Like, my systems have a couple indicators. One is where the setup is coming. Okay, I have these signals, the setup is going to come. Then it's the price action has to confirm it, or I don't do it. So, like, let's say the fundamental side is this, and then the price action side is the buy. If I post that, most of the people just buy it. They're like, oh, that's great. Like, it's obviously a buy. It's like, no, I literally could explain it to a T that, like, it's not confirming. And it doesn't matter that, let's say this has the craziest COT buy signal I've ever seen in my life. Or, like, fundamentally, this is the best commodity in the world at the moment. If the price action doesn't confirm it, it doesn't matter. So you have to have that, at least that filter of price action, or you're probably going to get killed at some point, because the price action really is everything.
Yeah, yeah. I mean, definitely. It's probably the most important thing that I use in everything I do. And from there, it's just deciding what how you want to go about it. Is your
Mm-hmm.
goal to have stability? Is it to make gigantic returns? What kind of volatility can you take? How does your goal reconcile with your temperament? Where's sort of the perfect union of those in combination with what's possible? So yeah, anyway, it's a difficult animal to be successful in markets consistently. And what I find a lot is the more that I study, the more questions I have.
Yeah.
Like a lot of people say, "Oh, give me the best system," and it's like, well, what's the best?
What
I
is
mean,
the best system?
best is subjective. Like, I think pizza is the best dinner, but
I probably shouldn't eat
right
it
for
every day.
everyone. Yeah, right, right. But
It is great.
yeah. So, what should we talk about now? System design, you think, or?
Oh, no, no, nobody wants that. But what's funny is, like, yeah, I could put out things and just and we, this for a fact, and I've said it before. I have this Bitcoin system, and it has this crazy. It has a really good win rate. It's, once again, I can't go back 50 years and back test Bitcoin, but it's a really good system. Has a very high win rate, and I talk about it all the time. I've given people the exact parameters of it a billion million times.
Mhm.
And people always go. So one time somebody said, why do you tell people this system? I said, because I could put it on a billboard and nobody would use it. And I
Yeah.
said, and if you did use it and just, you didn't back test it and you just used it yourself, you would, every time it had a drawdown or every time it got into something tough or a rough period, you wouldn't use it anymore. So it doesn't matter. So like understanding and having that, like, the one thing that I do see consistent in those trend following traders is that they might not have faith in anything they're trading, but they do have a lot of faith in their system. And they're like, this system over time will win, and they'll either go down with it, go down swinging with it or not. But most of the time, it does come back. And that's why those guys have, existed for so many years. So I guess a good question for you is, I have so many people who will be like, hey, trend following, like, I see that you're a trend follower and that's cool. And I looked into it one time and I realized that, the win rates are so low that I'm not really that, interested in it. And I'm like, these guys have made money for many years. What are you talking about? So, what do you say to somebody who would say something like that? Because that's some people will watch this who think those things, like, yeah, trend following doesn't.
What do I say to people who want unrealistic things from markets?
Yes.
I guess I did this study myself once with it was on drawdowns, and I just took a lot of different strategies in a lot of different markets. And it's been a few years, so I don't remember specifically, but even if you buy the stock market, you're really in a drawdown something like 95% of the time. You're almost never at new highs in any given strategy. And I think when I saw that, I said, wow, this is interesting, because we all have these fantasies that we're gonna, come up with something with no volatility that never loses and keeps rising, and it's just not the way it works. So I guess what I would say to someone like that, or what I would try to do, is show them with data the realities of markets and
Mm.
how they work. I've had people say to me before, like, well, I've been with such and such advisor for 3 years and I haven't made any money. And it's like, well, look at the way returns actually come in markets. They're clumpy. They're not normally distributed. I wrote something, I think I put it on the market meditations, but it was like the average return on the stock market is 8%. People say, okay, I can expect 8%. But I found that over the last 100 years, only like 3 or 5 of the years were actually within 7 to 9%.
Mhm.
And the range was huge, right? Like the highest return was 20 something and the lowest was minus 20 something, let's call it.
Mhm.
And so I think, like, when people have unrealistic expectations, you just have to try to show them data about what reality is, and see where it goes. And personally, if I have people that want things that are unrealistic, I usually will say, I can't do that. But if you find someone who can, please call me, because
Yeah,
I'd like to give
I will
them
get on
money
board as well.
too. Yeah. There are two things you said though before you asked the question. Like faith, I think, is a key word, right? And everybody has to have faith in something. And one of the things that's always struck me as slightly ironic with trend following is like it's all about cutting losses, because buy and hold is bad, but trend followers inherently buy and hold trend following strategies. So at like the next level
Yes.
up, you're a buy and hold investor of a strategy that cuts losses on everything but itself. I guess they'd call that meta these days, right? Or a few years ago. But yeah, I just always look at that and think, and maybe the reality is we all have to have some kind of faith in something that we're willing to say, I'll stick with this approach. um and I guess the other thing I've seen is like everything changes. The only constant is change, and you have to adapt. Pretty much. It's nice to think you can just stick with one system and trade it forever, but like look at the original turtle system. The sort of approximate back tests I've seen of it are it killed it in the 70s and early 80s, and then it did
Mhm.
nothing for 30 years, and then it came
Yeah.
alive again. But it's like, who can sit through that and have the faith for 30 years? I
30
mean,
years, nobody, like
right.
that's an important point, because I hear a lot of people talk about that, that style of the system, and it's good to read those books and understand. But once again, the market moved in a different way. Even go to like Richard Donchian's system all those years ago, it was 20-day highs and 20-day lows. That
Yeah.
system would get killed today. Like, maybe like a year ago, it would have been okay. Like, but most I would assume, and I think I back tested it at some point, is that it just did really bad in most periods. And then the period he traded, it worked great. So it's like sometimes it's a lot of curve fitting. The thing we have today that Donchian didn't have, is the ability to backtest all of these years. Like now we can go and like I can look at and say, oh, my system would have done well in the 70s, it would have done well, in the 80s, the 90s, 2000s, today, whatever. Like I can see that now, but I couldn't see that back then quite as clearly. So it's kind of interesting they were able to really do all that work, dig up all that data, work on it that much all the way back then with Donchian, and just come up with that idea. And then even another next step would be the turtles. And then today, like you talk to most of the trend followers, they have more long-term systems. There's some of them that have still kind of short-term systems, but they all figure out ways to make it work. And like you said earlier, with having stacking, having different type of systems. Like for me, I do that too. I have different types of systems, and I'll notice like I even keep track of them. Some environments like volatility breakout systems will be my bread and butter. It'll be the thing that makes all the money for a year.
Mhm.
And it's interesting because it'll be across all different assets, which I've always found super interesting when this happens. I have a couple mean reversion systems. Some years that's the one that's just killing it. So it's kind of interesting to see, like, and I always say, like, you kind of got to treat yourself like your own hedge fund, where you have maybe a couple different systems that you're trading here, and then maybe have a couple different strategies. Like you said, sometimes when you're just walking away, 2022 was a time I was also kind of going, hey man, like maybe I could do something with my money a little bit different this year. And I had a great idea to just kind of put it in those I bonds for a while, and buy a bunch of I bonds, do a bunch of different things with money because the yields were so great. And that made some money. And you could do a bunch of different things with these things. But once again, it's a constantly understanding what you said there. That's a good fact.
I lived in the islands for a while, and they would teach little kids to sail, and they would have these little sailboats scattered about. And on one side of the bay, people would have sails with wind, and the other side they wouldn't, and they'd motor over. And then by then the wind had gone back to the other side. And so I think one of the things I find with trading, and that's sort of an analogy, is like you have to be careful that you're not always chasing something new, because you can get the worst of all of it, right? And the fine
Mm.
line and the difficulty is like which approach is going to work now, or which strategy or which trend model. Is it going to be the 520 that Donchian had, or is it going to be the 5200? And nobody knows these things
Nope.
without the benefit of hindsight. And so for me, that's why I kind of got to a point where I wanted to design processes over systems, and I wanted some sort of fundamental underpinning to what I do. And that might be not so much like a secular trend in stocks, although I'll trade those. It would be more, hey, the vast majority of the world puts money into 60/40 because of modern portfolio theory and asset allocation. So I want to align with that and use principles. But I personally got to a point where I wanted to have some kind of fundamental backing, because I found if I was just using math and statistics, I could end up chopping myself up going from one approach to another. And if I diversified across too many different approaches, the returns became sort of not as exciting to me. And if I put leverage on them, leverage kills everything. I guess that's back one of the principles: don't overtrade, right? It doesn't matter how good your approach is, unless you never lose. If you use too much leverage, eventually the ship's going to sink. So back to the boating analogy. But yeah, that's kind of what I found, is just, these are the subtleties and the gray areas and the discretionary subjective things that there's no right answer. And as you probably know, I mean, you trade, there's the unfortunate reality is you have to make these decisions, or you maybe decide, hey, I don't want to be a trader. I'll have somebody else do it because I want a system that's going to work all the time. It's like, yeah, me too.
Yeah.
When you find it, give it to me. Like if Rentech starts taking money and they give me a call, I'd love it. But
and that's true. Like, like I see a lot where people will give me their money over the years and think that because you gave it to a professional, now it just goes up every day. And that's not the truth either. Like it's the same that you brought up a good point about clumpy returns. I think clumpy returns are the best returns, because I can think of, my two really great years over the years for 2020, 21 and the beginning of 22. And thinking about how great those returns were, I know that while it's happening, I also keep in my head that this isn't sustainable. Like that's a hard thing for traders to understand, especially clients. Clients have no idea. They're like, this is great. This is going to be like this forever. 100% returns are obviously super sustainable. And we're just going to do this for the next 40 years. If like that was possible, I'd be living on a beach somewhere and I'd just continue to do that by myself forever. However, it's not really possible to do 100% a year every single year. It is possible to have really good returns for a few years and protect that the next year or so, and to just have a decent return that year. Like have, you a 10-20% return. There's nothing wrong with that. That's a really great return, and just continue to protect the money. And I think the important things in trading is to make those returns when you can. They're not always going to come, so make them when you can. It's hard to tell. Like you can't exactly look at the market and say this is going to be the best year ever. Like but you might be able to understand that by liquidity or something, but it's hard to see. But if you can be like, I can make these returns during this time, this next period, I'm going to just, try to continue to like make a decent return, be okay with that. And then when that period comes again, then, rip the market's face off, and just try to sustain yourself during those periods. Because I think too many times what I see is that people get those really great returns and then they go, well, crap, this is a crap year, but like I have to get back to this, because if I'm not here, like my clients are going to be mad and they're going to think this, and like, people start to, and then you start to push your leverage, and then you're like, well, I could make that return, like, but the moves are only this big, so I better just leverage myself to death. Like you could just create all this crazy chaos in your own head as a trader. Or you could just say, hey, my number one goal is protecting my ass, like Paul Tudor Jones said. And because of that, I've made this great return, but I just need to protect that return and then continue to do that going forward. I think that's really the strategy. Like, yeah, you have all these different strategies and so on, but I think for all traders, that's something that's really in common that you see is like you said, there's clumpy returns, and then you have those wild returns at certain points, and then you have those flat periods, and then that ability, like you said, to just walk away.
Brought to mind something else, if I'm not interrupting you, but basically, no matter how you do it, there's going to be bad periods. And I'm not talking drawdowns. There's going to be, you're always going to encounter stuff where it's like, I didn't think about this. I didn't plan for this. And what I've found over time is, whether discretionary or system, you should have an overarching philosophy that guides your decision-making in such times. And for me, it's always survival. I think it was Nassim Taleb. he had a quote somewhere where he said like he studied surviving traders and he found that they were all obsessed with survival, not making money. And
Hmm.
so I think it's good personally to have like, okay, when in doubt, I default to this modus operandi, my
Hmm.
overarching philosophy of what to do. And for me, it's survive, because
Hmm.
if you study history, that's, that's what gets people to kind of win the race. It's the slow and steady. It's not the big and exciting. And to your point a few minutes ago too, like, yeah, there's really no evidence that gigantic returns are sustainable over time outside of maybe Rentech, which is, I wrote a thing on that that I can send you so you could post, but
Yeah.
what I think they're doing and why I think it's different. But yeah, I mean, people have these golden eras and strategies have great runs and they last a handful of years. And the guys who take a ton of risk in line with that make a ton of money, but oftentimes they blow up. It's like, to achieve returns in the triple digits, I mean, you have to be taking risk where if your strategy is not the right thing at the moment, you're probably going to get really nasty drawdowns, if not lose everything. And so, yeah, I just think it's the overarching philosophy for me of survival. And to a large degree, I think that dictates how you operate in a general sense too. Morgan Housel, I think that's how you pronounce his name, but he wrote a couple interesting books, and he talked about how
Hmm.
there's good people that are great at making money, and there's people that are great at protecting money. And usually
Hmm.
they're not one and the same. And you see that, we read the books. Like, I like to read the Livermore books.
Hmm.
I tend to dive in on a subject and read everything I can and then see what's consistent, triangulating. But like, Livermore was an exciting guy, he was
Yeah.
ups and downs and showgirls and divorces and this and tragedy, and then he shoots himself. And it certainly would be a great movie. Like, I think it's Baz Luhrmann. It'd be great if he did like a Gatsby-esque movie
Yeah.
with Livermore. I tweeted him once, but he didn't respond. But I mean, I guess like that type of stuff, that high shoot for the moon, make gigantic returns, usually has another side. And I don't think we see a lot about that in published media. I think we see the Goldilocks window and not the other side. So I guess that's just,
Hmm.
people are good at one and the other. I tend to be better at protecting money than making gigantic returns. But I think most of the people I've known who make gigantic returns, usually they have some big drawdowns after the
Bad
fact.
periods.
Yeah, and really
Yes.
bad periods. And that's where you get back to like managing your emotions. I mean, 5, 10, 20% drawdown, sure. 30, 40, 50, 60, 70. I mean, that's tough. Yeah, I've been told that some of the legendary traders of old would have 20% down days,
Yeah.
50% down months. I mean, 50% drawdowns were not abnormal when you were making triple digit returns. And I think we all say, hey, and I'm sure you can relate to this, but it's like, if I knew I was going to make 200% a year, I'd take the 50% drawdown 3 times. And it's like, yeah, sure. If you knew for sure, but when you get that first 50% drawdown, you're going to be like, can I handle it? I don't know. Will this be the time it doesn't come back? So that's
Yeah.
where I think a lot of emotions come into the game, ability
Yeah.
to manage that. So
No, that's a great point. Um, to end things off, is there anything that you could tell, new traders, people just getting into trading, or people who've been trading for a while that you would think is a very important thing to understand to possibly get to a level of profitability? Like what's that next level of profitability, do you think?
yeah, well, next level or just a level of
Or just a
profitability?
level of profitability, because
Yeah.
I guess what I'm saying is more, there's plenty of people who are at zero. What exactly, or negative, how exactly do people like that possibly get to a level of being profitable?
I guess I'd say read my free book for starters, because it's
Mhm.
hard to deny the conclusions I've come to since I provide all the supporting evidence. It's
And I'll put
repetitive.
that in the description
Oh,
too.
thank you. Yeah, but it's repetitive, but it's like, that's kind of the point. It's like, this doesn't change. What I wish I had known, if I could go back in time and talk to my, 18-year-old self, it'd be like, it's really more about cutting your losses
Mhm.
and knowing how much you want to risk, and then trying to identify what you're trying to capture, how much risk you're willing to take, if your temperament can take it, what your goals are, and then continually rejiggering that until you get to sort of the perfect blend for you that combines your goals with your temperament. But just focusing on know where you're going to get out before you get in. Don't believe any theory, idea, whatever enough. You know, the markets go where they're going to go. So focus on what you're going to do if it goes wrong. Don't spend too much time coming up with, you know, a gigantic, amazing idea. I mean, the Soros camp maxim was invest first, investigate later. And it kind of dovetails with what guys of old would say, where it's like take a small position, and if it starts to work, then research it and make it a massive position if the market agrees. And I think that's just so interesting, because when we watch TV, we see people talk about like my S&P target, or like sell me on your philosophy, and idea dinners and conferences where you present your favorite idea. But the guys that I think have the best track records, they didn't form a brain trust to put a position on. You know, they said, hey, anything can happen in markets. I'm going to respect that. And if it doesn't go my way, I'm going to get out. And, you know, they didn't spend too much time coming up with ideas. They might have really dug in if it started to work. But yeah, so I guess that was a lot of stuff at once. But I guess if
No,
I
it's
had to say
perfect.
one thing would be just focus on cutting your losses, focus on, you know, survival, and then go from there. I guess one other thing I'd add is like, you can't read or study your way into knowing how you experience markets. You have to trade to get that experience and come to know yourself as it relates to markets. And I think that, you know, that's something that's overlooked. There's like a quote from Fred Kelly, I want to say, where he's like, yeah, I can hit a wine glass stem at 50 paces with a pistol. And he's like, well, what if it's shooting back? And the point is, like, when you're under pressure, it changes your ability to perform. And so I guess I'd say, you know, you have to get that experience to start to learn about yourself and figure it out. And as you're doing that, while you're reading all this stuff and you're adhering to the principles, I think that's your best bet of success early on, because at least you'll know, cut your losses, cut your losses. That's where it's at. You know, if I had a mantra, it would be cut your losses. So
Yes.
yeah.
No, it's true, and I love the way you said that and the way you explained it. It's like in sports too, you know, when I was a bike rider, it's you know, a contest is completely different than riding by yourself. And same, like, you know, you're shooting a basketball around, if nobody's standing in front of you, like, yeah, I can make a lot of shots with nobody standing in front of me. You know, that's a whole different thing when you got people running at you. So you just have to understand that and learn that about yourself. So thanks for coming on, George. This was a lot of fun. I'm so glad. I hope you can do it again with me at some point. I'm so glad I finally got you on here after all these years. And congrats on moving on to what you're doing right now. And looking forward to talking with you again.
Thanks, Jason. Appreciate you having me.